The latest headlines and market reports from big box companies suggest the market is shifting again towards a housing recovery. But in today's video, I'm breaking down the local stats and recent headlines to show you that it just isn't true. And stick around to the end where I'll show you how the market conditions are actually different for different kinds of buyers. Some getting better, some getting worse, as well as a headline highlight of everything working against the housing market right now. That's all coming up right now, so let's get started. So as I mentioned, the latest real estate headlines would have you believe that the market is recovering and shifting again towards a seller's market because as we discussed last week, buyer demand rose quite a bit over the last several weeks. But this week we have more data showing that those headlines just aren't true and that the market is actually getting better for cash buyers and worse for buyers who need to finance. Plus, there's more economic data showing we're heading for a deep recession. So let's start by taking a look at that local data showing that the headlines are wrong. With the southern part of Southwest Florida, new listings went from 978 last week to 958 this week. That's actually down 2%. So still, we're not seeing any huge drastic changes here in new listings coming on the market, but we did see inventory tick up, and we'll take a look at that in the next slide. Solds went from 501 to 551. So that's everything that happened over the last 30 to 45 days. All those pending sales did actually sell off over the last 7 days. That's up 9%. And then pendings went from 1016 to 996. So that's actually down 2%. So that is a difference. The last several weeks, we've been seeing pendings increasing because mortgage rates were decreasing. Now we're starting to see the mortgage rates increase again, and that is actually bringing the buyer demand down. So we are going to see pendings probably continue to fall as those rates continue to rise. Price decreases actually did subside 3% as well. That goes hand in hand with the amount of demand coming in. We're not going to see as many price decreases if demand is building up again. But that trend is starting to shift again the other way, and we'll take a look at that in a couple more slides. Latest inventory breakdown. Last week, we had 5483 for single family units, which is pretty close to all-time highs. And this week, it went up even higher to 5522. That's up 39. Condos, also same thing. We're at all-time highs really for inventory on the market. This week, that's up to 2907. That's up 83. So last week, we had a net gain of 92. This week, we still have another net gain of 122. So inventory is still rising in the southern part of Southwest Florida. Multifamilies, we saw a decrease of 3 here to 148. And foreclosures, we saw an actual increase of 1 to 51. So no big changes in either of those categories as well. Total sales, 388 over the last 7 days. And out of those, 231 of them were cash sales, which is 59%. So still well over half of them are all cash sales. All right, let's take a look at some of the weekly trends. I did want to show this because we are getting more data now showing over the past couple months that's showing the trend lines. And these trend lines are going to be important as we continue moving forward into 2023. New listings, as you can see, when we go back to October, really right after, you can see the huge drop there, which was from the hurricane. So we had a large drop off in new listings coming on for the next couple of weeks, but we did see it pick back up. Now we're starting to see the trend. It has returned back to normal. We're getting up to almost all-time highs over the last year for new listings coming on the market. So that trend line is increasing over the last several months. So that's important because that's going to really determine where prices go. More listings are coming on and the buyer demand is still low. That's going to push the prices down because there's less demand for more inventory coming on. The other one, weak supply of inventory. This is also increasing. We've been seeing this increase pretty steadily with how much supply has been coming on the market. We're pretty close to 6 months, which is right where we want to be for a balanced market. Also, closed sales are on the decline. That's really been going on since pretty much the end of April. We've been seeing a pretty steady decrease in the amount of closed sales, and that doesn't have to do with inventory anymore. So inventory has been increasing pretty steadily, but closed sales, or the amount of sales that have been coming off the market, has continuously declined. And we're starting to get to all-time lows again over the last 2 years. The other trend that we want to take a look at is the percent of list price received. So this is for sellers who are listing their home. They have it started at a certain price point, and then this is what they're actually getting. So they've been getting 95% of their listing price. The last 2 years, we've been seeing most of the percentages at 100%. So people have been getting asking price or higher. Now we're starting to see that that's actually going lower than what they're getting at. And I can tell you that some of my recent clients have been getting their homes way underpriced. That has to do with part of the program that they're in, but the other part is just negotiating and knowing what the actual comps are and making sure that you're getting the best deal. All right, moving on to the interest rates real quick. We did see interest rates rise slightly according to Nerd Wallet. It did go up a little bit, and then Bankrate actually had it falling over the last 7 days. But this is as of today. So we are going to see, based on what's going on in the bond market, we are going to see those interest rates rise again, unfortunately, for those of you who are looking to finance a home. Mortgage applications, last week we saw it increase 7%, which is quite a bit. We've been seeing it right around the 1% range, increasing and decreasing. Now we're seeing it up 7%. That goes back to the fact that mortgage rates declined quite a bit over the last couple weeks, and they kind of hit an all-time low last week. So that's why we saw this increase. But they're on the rise again, so I don't think we're going to be seeing this type of increase anytime soon again. Refinances, that went up from 31.2 to 31.9. FHAs actually decreased quite a bit. This was a huge decrease here. VAs increased. This was the biggest increase here. We were up almost a little over 1 percentage point here, and then USDA loans, of course, did not change at all. This is the 10-year bond, and this is what we really follow for interest rates. For those of you who have been watching, I wanted to point something out because this is where I see things changing quite a bit. The left-hand bar, where the yellow bar is and the arrows, you can see that we were at the RSI, which is on the bottom, is really the momentum indicator of buying and selling. So who's buying, who's selling. The MACD also indicates what the momentum is. Both of those back in August of 2022 were showing that we saw that's where rates really started to tick up. And you can see that the RSI and the MACD, which are the bottom two sections, the bottom two arrows, those were right around the same levels that we're at right now. So if you take a look at the right-hand bar, this is where we are right now as far as the RSI and MACD are concerned. We're right about the same levels we were back in August. And I did mention last couple of weeks that we hit that 200-day moving average, that white line on the top. That is the 200-day moving average, and we bounced off of it. So that became support, which means that interest rates right now are going to be heading higher, and they have started to head higher over the last several days. Unfortunately, where we're at in the MACD and the RSI shows that we have, if you look back at that first indicator, you can see how much the interest rates rose from August all the way up into really the November area. That's where we kind of hit our peak and our double top in the interest rates. We're in that same pattern right now. So this could be the start of another high or increase to higher mortgage rates. So this could really indicate we're going to 7%, maybe upwards of 8% for interest rates. So if you're a financing buyer right now, is, as far as the charts are concerned, is the best point to get into the market. If you're looking to buy anytime in the next really 6 to 12 months, this could be your chance to get the lowest rates right now. I'm not saying that to conjure up fear or anything. It's just based on the charts, we could be heading higher for quite some time, and we're not going to really know when that's going to come down, because as of right now, the markets, the economies, the stock market are fighting the Fed, and you don't want to fight the Fed. Basically, everybody's thinking that the market is starting to rebound, which means everybody's piling back into stocks. And if that happens, the Fed is going to have to continue raising rates because they're trying to stop that from happening. They're trying to decrease people's portfolios. They're trying to decrease job rates. Right now, we're seeing a lot of layoffs, which we'll cover in a minute, but that's good news. But the fact that people are still piling the stock market is showing that the Fed is probably going to have to keep raising rates, which is going to go against what the bond market's pricing in right now, which means bonds are probably going to go higher. All right, so just to recap, I'm going to just blow this up for you guys. For loan buyers, anybody who's looking to finance right now, on the left-hand side, the pros right now, what's helping you? There's increasing inventory, which is driving prices down. That, as you can see, buyer demand is still pretty low. So there's not a whole lot of buyers in the market right now, which means you have a better chance of getting your offers accepted for one, but also getting better prices. So not necessarily having to offer full asking price. The other thing right now, builders' prices are also declining, and they are also increasing the amount of incentives that they have. So if you are looking to buy, new construction might be the way to go, especially in the near term. Cons, things that are working against you, competing with cash buyers. Cash buyers right now are entering the market quite a bit, especially down here in our area. The rising interest rates are working against you right now. So time is of the essence if you're looking to buy soon. And then the economic and job uncertainty right now. There's a pretty bearish outlook on the economy right now. Cash buyers, you guys are in the best position right now. The pros, increased inventory means prices are decreasing. Buyer demand is still pretty low, so you don't have to compete, and you're also able to get better prices or make better offers against sellers. The other thing is builders, prices, incentives. You guys can take advantage of those as well. Things that you are competing with, obviously, you're competing against other cash buyers, and then the rising interest rates really is. I put it here as a con, but it's really a pro for you because you don't have to worry about that. Sellers, you guys are in a tough position right now. It's kind of give or take. You know, the old adage goes, if you're going to buy high, you're going to sell high. If vice versa, same thing. If you're going to sell low, you're going to buy low. So right now, if you're looking to move or sell your home, pros working for you. Inventory is still considered pretty low, considering buyer demand did pick up recently, and it might pick up for the next week or two, but it's probably going to slow down. So cons working against you, home prices are decreasing right now because inventory is increasing. Buyer demand is still pretty low. So that's not going to help you raise your prices or get higher and higher higher and higher equity on your home. And then you're also competing with new construction, who is incentivizing their buyers quite a bit right now. And a lot of people really love to buy new construction because they don't have to worry about anything. All right, real quick, I want to go to the wall of worry. I'll go into a couple stories a little bit, but most of it's going to be just covering the headlines. And you can kind of get an idea of where people feel or what the sentiment is on the economy and the housing market. Right here, this is from Redfin. A record 25% of home searchers look to move to a new metro area at the end of 22, as high housing costs drove relocation. So as you can see, it's been increasing according to Redfin, and some of the best places to live. 5 of them were in Florida areas, and 3 of them are in our areas down here. So actually 4 of them are in our areas. So Miami's down in the southern part, obviously. The other coast, Tampa, still considered Southwest Florida. People moving to those 2 areas are mainly from New York. Cape Coral and Northport, Sarasota areas. Most of the movers that are relocating are from Chicago, Illinois. And then you have the Orlando area, which is also from New York. Also, just take a look at what some of the last reports from Redfin have been. Just the headlines here. Housing market update. Pending home sales improve in January as more buyers return. The housing market has started to recover. Pending home sales rise for the first time in 14 months. So these are the headlines that people are looking at and saying, oh, the market's changing again. It's shifting back towards the seller's market, but it's not. As you can just see from all the data and all these headlines coming up. So these below some of the largest employee layoffs that have taken place in 2023 so far. That's not counting everything that happened in 2022. So we had Amazon laid off another 18,000 jobs, Microsoft to eliminate another 10,000, Salesforce around 8,000, IBM, Goldman Sachs, S&P SE, the Bank of New York Mellon, Coinbase, BlackRock. BlackRock is a big one. So that's going to be a huge decrease there. Philips, Spotify, Vimeo, Bed Bath & Beyond, they're going through bankruptcy right now. So they just closed, I think, 82 stores or something over the last couple of weeks. So these are what we've been talking about for quite a while now, and what we were worried about. This is what the Fed has been trying to cause. So it's happening, but it's slow. But the other part is the fact that people are still trying to invest in the market, which is not going to be a good thing for the Fed to stop raising rates. Also, here's how prosperity ends. Global bubbles are popping. This whole article goes into the different types of bubbles that we've been seeing. One of them being the car, which is the next headline. More Americans can't afford their car payments than during the peak of the financial crisis. There's a whole bunch of articles on that right now. The Fed, latest to shrink rate hikes again as inflation slows. Again, this is not good news. This is bad news because all of the data that's coming out right now is suggesting that they need to continue raising rates because it's not doing its job. people are still entering the market. Even on $100,000 plus, more Americans are living paycheck to paycheck. The U.S. debt ceiling, so high interest rate bonds, the U.S. debt limit options aren't great. They're going to have to come up with some creative ways to raise that. Quiet quitters climb as layoffs mount. And then also the last one, Wall Street is losing out to amateur buyers in the housing slump. So this just goes into a couple, smaller buyers who took advantage of the market and sold right at the peak or as the peak was declining. And now we're hearing about all these iBuyer programs in Wall Street who was buying and buying homes. Now they're starting to sell for losses and they're going to have to sell even more. So that means more inventory coming. That means prices are going to be declining, which is going to be good for cash buyers, like I said. But for financing buyers, if bonds continue to rise and interest rates continue to rise, you're going to have higher and higher interest rates to afford a mortgage. So consider thinking about that. If you are buying fairly soon, that you might want to lock in your rates right now, and it might be worth paying the extra to extend those locks if you have them already. If you're thinking about buying in the area or not finding what you're looking for, you might want to check out this next video on how I've been helping my clients find off-market and unlisted deals way under market value and why more buyers are choosing to work with us in this uncertain market. We had a few spots open up this week, so if you're thinking about buying in the next 3 to 6 months, this might be a good opportunity for you to find something at a great price and with some pretty awesome guarantees. Well, that's it for this week. I hope to see you in the next video, but until then, stay safe, stay positive, and more importantly, stay free.